Hello student, this is Palladarbari, your host, and you're watching Palladarbari classes. This is the chapter 2, Macroeconomic class 12, Money and Banking, volume 7. Firstly, see the cash reserve ratio. Every commercial bank has to keep a fixed percentage of its net deposit time liability in RBI. The commercial banks keeps the ratio in cash in RBI. Through cash reserve ratio, the central bank influences the level of aggregate demand by controlling the availability. So what is cash reserve ratio? Remember one thing, every commercial bank has to keep a certain percentage of their deposits in RBI. They keep the deposits on the basis of net deposit time liability in RBI. The commercial banks keep the ratio, they deposit the money in cash form only. So every commercial bank has to keep in RBI, every commercial bank has to keep cash in RBI to maintain the cash reserve ratio on the basis of net deposit time liability. Through cash reserve ratio, central bank controls the supply of money and check the problems of inflation and deflation. Remember one thing, in the case of inflation, RBI increases the cash reserve ratio. What happens when the RBI increases the cash reserve ratio? See, when the RBI increases the cash reserve ratio, it means that commercial bank has to keep more and more money in the RBI, and they have to keep more and more money with the RBI. When they are keeping more and more money with the RBI, they are left with less cash balance. Since they are left with less cash balance, so they are not in the position to give more loan to the people. When they are not in the position to give more loan, the supply of money will be checked and the problem of inflation will be checked. Remember one thing, when I say the problem of inflation, we should know why the problem of inflation is arising. The problem of inflation arises because the purchasing power of the people increase. When the supply of money will be checked, the increasing power of the people will be checked and they will not demand for the commodity, and the supply and the demand of the commodity will be equal. So the price will not increase. Let us see what happens in the case of the deflation. In the case of the deflation, RBI decreases the cash reserve ratio. When the RBI decreases the cash reserve ratio, then the commercial banks have to put less money in the custody of the RBI. When they are putting less money in the RBI, they are left with more money. So they are now in the position to give more money to the people. So the supply of money will increase. When the supply of money will increase, the purchasing power of the people will increase. They will demand more and more goods, and the demand now becomes equal to supply. So the problem of deflation will automatically checked. In this way, through the cash reserve ratio, RBI controls the problems of inflation and deflation. The day I am recording this video, the cash reserve ratio is 3%. Remember one thing, monetary policy is the bi-monthly policy. It means after every 2 months, the RBI revive the policy. They review the policy, they decide whether they will change the cash reserve ratio, liquidity ratio, or whatever, or they want to continue with the same rate. Now let us see the next thing, that is the statutory liquidity ratio. Every commercial bank has to keep a fixed percentage of its NDTL, net deposit term liability, with themselves. The commercial bank keeps the certain percentage of NDTL with themselves in the form of cash, gold and government securities. Through the statutory liquidity ratio, the central bank controls the supply of money and check the problem of inflation and deflation. Listen, in the case of the cash reserve ratio, we have seen that commercial banks have to keep money, certain percentage of their deposits in the RBI. So in the case of the statutory liquidity ratio, every commercial bank has to hold a certain percentage of their deposits with themselves all the time. It means that money which they are holding all the time, they cannot give that money to the people in the form of loan. They have to hold it in the form of cash, gold and government securities. And through this, the government through this RBI check the supply of money. Let us see what happens in the case of inflation. In the case of inflation, RBI increases the liquidity ratio. It means that if the problem of inflation is there, then the RBI increases the liquidity ratio. Now all the commercial banks are supposed to hold more and more money in the liquid form. It means they are not supposed to give the money in the form of loan, but they are supposed to hold it all the time. When they are supposed to hold more money and they can't give it in the form of loan to the people, the supply of money will be checked. The people will get less money, the demand will become equal to supply, and the problem of inflation will be solved. Similarly, in the case of deflation, RBI decreases the liquidity ratio. It means the RBI tells the commercial banks to hold less money. When they are supposed to hold less money, then they are in the position to give more money to the people in the form of loan. The supply will increase, the people will get more money, they will demand more and more goods, and the demand finally becomes equal to supply, and the problem of deflation will be checked automatically. In this way, through the statutory liquidity ratio, RBI controls the supply of money. The day I am recording this video, the statutory liquidity ratio is 18.5%. Let us see the basic difference between cash reserve ratio and the liquidity ratio. Remember one thing, cash reserve ratio is being maintained in the RBI and liquidity ratio is maintained with itself. I mean the bank maintain it with itself. Cash reserve ratio will always be in the form of cash, and the liquidity ratio will be maintained in the form of cash, gold and government securities. Cash reserve ratio should be according to the section 42(1) of the RBI Regulation Act 1934. So the cash reserve ratio should be according to the RBI Act 1934, section 42, subsection 1. And the liquidity ratio should be according to section 24 of the Banking Regulation Act 1949. That's all I have in this video. Thanks for watching. God bless you all. Dear subscribers, if you have not subscribed my channel, please subscribe the channel and don't forget to press the bell icon so that whenever I upload the new video, you get the notification.